Well, I mean, all of these days are super painful, but I look at this as a multi-year sort of drama that's playing out. So we had 10 years of central bank expansion in the U.S. and everything was going one way, and now it's not. And unfortunately, we're still in the early innings, I think, of central bank tightening if you add in the ECB to the Fed and the Bank of Japan.
And it sounds like the ECB and Bank of Japan are going to be a long ways off. So could this be a very, very long game in terms of the pain that we feel from tightening around the world?
It has to be really slow. I think the ECB wants to make it really slow because their economy is not as strong as ours. And they have QE to stop first, and then they have to raise rates. So we're looking years ahead, I think.
Vahan, what are you telling clients right now in terms of how they should be viewing the markets? I mean, if you listen to what Jan has to say about tightening and the tightening that is yet to come, should we feel any better about the, a year out, 2 years out when it comes to equity market returns?
Well, yes, I think we should feel better about 2019. I think what may be going on is a situation where next year you could see the majority of stocks actually outperform the indexes. Keep in mind that the indexes are market cap weighted, at least most of the indexes. And we've had a situation where many of these indexes have been driven up by these very large cap names. And now that we're seeing a lot of selling, it's the larger cap names that are really getting hit a lot. You know, stocks like Amazon are down 30%. So I think next year we could see that some of the smaller names can outperform the indexes, and I think that's when it makes sense to be a lot more selective with your stock picking.
By the way, we're seeing quite a market comeback in just the past half hour, I would say. We've basically pared our losses on the Dow by more than half. So we're down by 302 points right now. 1.3% is the decline. On the S&P 500, we were just here, 1% here. 2481 is the level, down 25 points. Jan, when it comes to this debate about active versus passive, we were chatting during the break. 80% of your business is passive ETF investing.
Right.
A lot of the ETFs own the same stocks over and over and over again. What impact does that have on the markets?
Well, I like to stress that not all ETFs are the same, and as the prior guest said, or the other guest said, a lot is very large cap oriented. And most active managers have, I would say, a lower market cap tilt. So it's not fair to compare active managers against a large cap index in an environment where large caps are outperforming. So I agree that the story of the market's going to be a lot more mixed between small cap and mid caps. So look at the ETF exposure. That's what you have to look at. That's our story.